Welcome everyone to the Kendall Report for Monday, February 24th, 2020. This is the final full week of February. I had discussed earlier in the month that the way that February goes will have a lot to do with how the next couple quarters go and potentially the rest of the year. We did manage to move much higher. We made an all-time new high again this month, but the last couple of days and overnight we're seeing quite a bit of weakness. I'll discuss that shortly. But we're seeing the market retrace pretty substantially over the last couple sessions. We just printed the 3380 plus level, and then the market's moved back pretty quickly here. And it's interesting because what we're seeing in the database from a trade standpoint is still a positive rotation. In spite of the slight downtick last week, we're still seeing a positive rotation in the database. And I'll go through all these elements here shortly. But overall, the weakness that we're seeing out of Asia overnight is everything to do with the coronavirus. I think there's like 6 or 7 cases in South Korea. So there's kind of a little bit of a freak out going there as far as those numbers go. I mean, it's 6 or 7 cases. I think this thing's way overplayed yet. I think the reaction to it is way overplayed. And, I've talked quite a bit over the last several weeks. I still think that most of the activity in China was China being able to show they can build a hospital in 10 days to handle the cases. They're showing they can lock down 86 million people and basically lock down an entire area. I still think it's somewhat of a military exercise more so than this virus out of hand, because it's really not that substantial. And I continue to follow a lot of different reports, but the markets, the media is really playing this up, and the disruption of the supply chain and all these things are being played up. And I'm just going to put something out there in the opening commentary here, is that this may end up to be a real positive for the U.S. and a real positive for maybe U.S. manufacturing. The reason why I say this is that what's really happening here is we're learning a really hard lesson about outsourcing our economy to China. And this could trigger much more activity, people moving production sources back to the U.S. to more friendly environments. And, I just think this could play out that this is a big setback for China. And is that going to affect the world GDP? Absolutely. And in fact, we have, we'll go through all the details here in a minute, but we have GDP coming out here in this country, the report on Thursday. But the bottom line is this thing could actually end up to be a real positive longer term. And it's just a matter of how overblown this thing gets. Like I said, there's not that many cases. I saw a map where they've made it where there's 2 or 3 cases, so they're painting the whole world map. This is spreading all over the world, and it's very, very few cases. So I just don't see the pandemic scare that they're trying to put out there. Let's face it, the media, clickbait, everybody, it's all about fear anymore. If you can generate some fear, there's money to be made. And, so that's just my view of things. But in spite of that, we're seeing market action that we have to pay attention to, and we're seeing quite a bit of weakness overnight. But before we go through the markets, let's go ahead and just look at the schedule for this coming week. On Monday, we've got the Chicago Fed activity index, Dallas manufacturing. Once again, manufacturing should continue to show a bit of a bounce, and I think we're going to continue to see positive numbers in a general sense there. We're looking on Tuesday, we've got the housing prices, consumer confidence, Richmond Fed manufacturing. Once again, manufacturing is going to be really key. Wednesday, new home sales, and State Street investor confidence. I'm not sure very many people look at that. On Thursdays, the big number, we're looking at GDP. It's expected to continue to show about a 2.1% increase. Jobless claims have continued to be quite positive over the weeks. And then we have, over the past, I don't know, 6 months, we continue to see some real stability and actually continue to stay at some of the lowest levels we've seen in a lot of years. And then pending home sales, those are going to be watched pretty closely. This is one of the hot spots in the economy, and that's going to be watched really, really closely. And on Friday, we're looking at not a lot there. Retail inventories, no one cares. Nothing's real there. Chicago PMI probably will be looked at with a fairly close. But this week is going to be really all about, this is what this is going to be about. We still have the final big week of earnings to come out, and let's talk about that for just a minute before moving on. The earnings reports this week total 816. We have 90 on Monday, 193 on Tuesday, 236 on Wednesday, 261 Thursday, and Friday 36. And I would only say that these are likely to still remain supportive as far as the forward-looking statements that come out. Maybe there'll be some things that come out about the coronavirus. Like I made the comment on Friday's commentary, is that this is the go-to excuse just about for everything. And I also mentioned the other day that, is Apple using their flat sales and iPhones, are they using the coronavirus as an excuse? And, there was a little bit of downside one day, and then Apple came back, but now all the big tech high players are pulling back here in this little pullback that we're seeing. But the bottom line is that's the go-to excuse just about for everything right now. And so, as far as the earnings reports go, looking in the rearview mirror is going to look pretty good. We're going to continue to see outperformance, and then we'll see what kind of statements come out of the forward-looking. I think everybody's going to hedge their bets here, and it's just a matter of how emotional the markets get, and we're going to look at the technicals here and see what's going on overseas in just a minute. I bring up the futures here, and you'll see we're down 1.24%, down 41 handles right now in the futures at 32.98. And I'll go through the cash numbers here in a minute, but there's a substantial amount of support here. You can see we've dropped, and this is the whole session so far on Sunday evening. It just kind of dropped, and now it's stabilized and went flat. I suspect we'll see quite a bit of recovery by the morning, as especially once Europe opens and we start to see how everything plays out. And so there's a lot of emotional stuff going on in the markets right now. And when we go over here and take a look, there's quite a bit of activity. Gold was up nearly $40 at one stage. It's faded substantially, up $18.50. We'll cover all these markets here as we go through the show. But the S&P took a pretty good hit on Friday, and we saw it trade down to the 21 period moving average. We finished at 33.37. Just 3 days prior to that, I'll bring this up on the screen, you'll see that we printed 3393.52, which was the high. So we're pretty close to being 100 points off the highs in 3 days. And you're going to start seeing, I think, substantial amount of volatility. One of the things I do want to point to on this screen here is you'll see that the PPM1 has just collapsed very quickly. PPM2, all three of the primary momentum indicators that I use are all showing weakness or flattening off. Now, none of them are in trend modes down. The actual PPM2 and 3 are actually in a positive mode. So we're likely to see a move down to this 40-period moving average like we did before, and there's going to be some stability here. So chances are unless there's some other news that is going to get triggered even further, there's going to be substantial support at the open in the morning. So the buy the dippers will probably be out in force. Now I'm going to show you. I'm going to click over here in this chart. I'm going to change it to the futures, and you'll see the futures are trading just below the 40-period moving average on the futures. They're slightly different numbers, but 32.9876 is the 40 is trading right now 32.98.50. So it's trading right on that number. The PPMs, even with the calculation of this, have not accelerated a lot. They're all PPM 1 and 2 are negative. PPM 3 is still positive, but is showing quite a bit of loss of a huge loss of momentum. And so this is likely to set up more of a pattern here. And if I go in here and I'm going to draw in a couple things, what's likely to happen here, there's going to be some pretty good support along this in this channel that I'm drawing in here. So we're probably going to see this kind of bounce in here. We'll see how, but I think this is going to be more or less the trend phase is going to come up. This is going to be more obvious when I go to the weekly charts, because it's going to show that there's lots of moving averages and lots of support underneath this market. So the underlying trends on a short-term basis, everything's been broken. We're in a neutral mode. Nothing's in downtrend modes, but it's certainly suggesting that we're going to be flat to down, and we're going to challenge some key numbers. And I'll talk about on the intermediate where these key numbers are. So let's go ahead and take a look at the weekly graph, and you'll see here there's the 10-week moving average. Now this is the futures I have up here again. So 32.92 is the 10-period moving average, but we still have a positive 0.22, which tells us there's pretty substantial support right at these numbers, which that number, the 10-week moving average, is very similar to the 40-day moving average. And then you'll see 0.52 over here on the left, 0.52 and 0.37 is PPM 2 and 3. So everything's still in a major uptrend, and there is a bit of a gap on the futures. Let me go over to the cash markets again, just so you can see. Now this is the cash. You have a pretty good reversal that came out of the weekly last week, and so we're going to see some follow through in the morning, and we're going to start, we'll go down towards this 22.85 is the 10-week moving average on the cash market. My estimation is that we'll see somewhere between 33.06 to that 32.96 is going to be support on the open in the morning. If it breaks through that, then the next level will be that 32.84 to 32.75. But I think you're going to see a sharp rebound if we get down that low. The bottom line is, this is, the coronavirus still is not going to affect the U.S. markets that much at this moment. I think by the time that the end of the second quarter goes on, that this thing will continue to dissipate and get more in the rearview mirror. I think it'll. I was watching a report overseas, overseas report. And they were talking about a lot of folks are going back to work. There's a lot of folks that are working from home in China now. A lot of things obviously manufacturing is affected, but there's a lot of other activity that's starting to come back pretty quick. So we'll see. This is, I'm saying don't be emotional. The trends are still here. I'm not worried about things, and I'll show you in a minute. Like I said, we're still seeing a positive rotation database. We're not seeing a liquidation mode come out at all at these levels. So, it's going to take a number of more weeks of, I guess, more momentum to be lost. But let's take a look at the monthly graph, which is going to come into play this week since this is the final week of the month. Right now, we never saw a lower low from last month. The close last month on the cash market was 3225.52. So anything over 33.03 is going to be positive. If we did finish above 33.21 on Friday, that would be a very would set up a very strong mode for continuation to the upside. And it goes back to that theme I was talking about, that the way that February goes is going to have a lot to do with the next couple quarters of activity. And you look at the PPMs on the monthly, it's just off the chart. You got 1.30 positive, 1.05, and 1.13. And you're also seeing that they're accelerating. Now, I'm going to throw up the futures here so you can see what the negative number does. It doesn't affect any of these PPMs at all on a monthly basis. So any higher close above this 32.25 is going to be positive, but especially if we finish over 3,300. And I had put that out earlier in the month. So that's still exactly what's going on. So let's go ahead and take a look over at the database and get a view of what's going on there. We start to look at the database. We still have overall equities bullish at 57.37. Mutual funds are 73.22. A big chunk of the mutual funds, why they're so positive, is a lot of the bond funds that have come back into play, and ETFs are at 60.13. And to a point, that has also affected the ETF sector as well. We look at materials, you can see there's a lot of dark green on these charts, and that's positive rotation. So if we look at these down below here, you're gonna see, some red, but mostly dark green, which is new buys. Here's some red here, office equipment, no material. Industry groups here are getting affected. And we look at the sectors here, you've got really a rotation. Basic materials have kicked in, and that has a lot to do with the strength in gold and some of the metals here. Energy, amazing enough, actually got some traction after last week. Financials, you can see just pretty much across the board, we've seen some pretty strong flow still coming in the database. So what that means is the models are still picking up positive trends. So this thing is not rolling over. I've been watching this database for a better part of 25 years, and this is not how the top looks. Now it could end up to form a top, and that may be what we're starting to see on the technicals. But there's, like I said, on the monthly, on the secular graphs, I mean, it's way too strong to be yelling and screaming, Chicken Little, the sky is falling. That's not the right thing to be doing at these levels right now. We're definitely seeing still a positive rotation. So looking over at the 2.0 database, you can see that 58% of the sectors are long, 67% of the groups, and we're at 72.73% of the overall database is long. So this, under 42 is a negative sign. We're still got a lot to go here. And we'll take a look at the all stats page, and what you'll see here is the same thing I've been talking about for a while. The average days long on the optimized weekly is 207. The current days long is 72. And we're looking at, we're 4.41 or 41% fulfilled. And the average profit is 30. And right now the average profit is only 7.8. So we're only about 26% fulfilled on the weekly model. So we're a long ways off from seeing anything really negative here from a database viewpoint. And this is a different way to look at markets. If you just look at the indices, it feels terrible. But when you start to look at the breadth of the market and how things are unfolding, there's something to be said for looking at the world from this viewpoint, because there's a lot of activity that's still showing these trends are incrementally coming into play. And so this is really positive. So then we look at the sectors below. Look at the gains that we have in some of these sectors. Transportation is huge, up 22%. It's been long. That's on 110 market days. So, the biggest gains are transportation, technology, we're looking at capital goods. All of these sectors that were long have done really well. The utilities has been on for a while. That has everything to do with the drop in the interest rates that have been unfolding over the last several weeks as the flight to quality or flight to safety continues to happen. And we'll take a look at that here in just a few minutes. But the database in itself is very, very solid. This is not where this thing comes to an end. It's just, would be highly unusual that that would be the case. Now, if we see more weakness this week, we close under 3,300, then maybe we'll start to see some of these trades start to come off. But it doesn't look like that's what's going to happen to me when we're looking, especially at the intermediate charts. When we're looking at the S&P and looking at the secular trends. There's just, they're very powerful. These things don't roll over like that. And if you've been watching this show or my broadcast for the last 5 years, I've been talking about this underlying trend has been in place for a very long time. It has not broken down. We've had some moments where things look pretty weak, but this is not what it looks like. Okay, I guess I got that point well made. So let's go back and let's take a look at interest rates and the dollar and some of these other items. Looking at the 10-year notes, I was last week I was really talking about seeing this thing stabilize a little bit, maybe moving back into the 160 range. Well, once again, the last two sessions where we saw this selling come in again, we've seen a substantial move into treasuries, the flight to safety trade. I'll show you in a minute here, but the dollar continues to be very strong and moving higher. And right now in Asia, it's doing very well overnight, in spite of the strength in gold. Gold is not responding to what's going on in the dollar. That trade is disconnected at the moment. But on the interest rates here, we see spike all the way down to the 143 level, and it's likely with the weakness that we're seeing in the futures overnight, if this thing stays this week coming in the morning, we may see this thing print down 137 on the 10-year. It's going to be somewhat interesting to see. I'm going to put on some Fibonacci patterns here just to see if there's anything there that looks like it's going to go. Yeah, so this is interesting. So the Fibonacci patterns is suggesting that we could see substantial move down. Take a look at this. We could see a move down to 128. There's even projections down to 1.13 and all the way down to almost, let's call it 1%. Typically, when we get these kind of big moves projected down, maybe it gets to the first number. It very seldom actually will reach these other Fibonacci numbers. And the next couple of days and how the markets respond as far as the recovery, if the weakness stays in or what gets played out here, this chart is likely to be climactic and start to move back into the 155, move back toward 160. But it could go to 137, and the extreme right now would be we'll call it the 130. It's 128, but we'll call it the 130 level. It's possible to go down that low if there is a bit of a panic over what's going on here. But the real numbers to look at here, when we look at the intermediate chart, you see the downtrend is just accelerated again. We've got big numbers, minus 2.0, minus 0.55, and minus 0.125. These are big downtrends on intermediate, and then we go over to the secular trend, and it does. You could make an argument this thing is going to go down a whole nother level, so that 1% level would be likely. We get huge number, minus 5.53 on ppm1, minus 2.71 and a minus 0.038. So those are very big numbers. I really thought we would see some stability here. The lows that we printed over here at 142 was the low that we made. Takes out 142. Like I said, I think 137. You could see a reversal here, but there's some strong possibilities going 130, and the extreme is now 1%. So this is pretty substantial. The other thing that we're seeing, looking at the yield curve, is this number here. You can see we're starting to see a bit of an inversion again, and we're coming down where the 5 and the 5 and the 10s are starting to get underneath the 13-week T-bill. So don't be surprised if there's some rhetoric coming out of the Fed. I know I believe there's a G7 meeting right now. I believe it's a G7 with the central banks are all meeting at the moment. So there could be some statement that comes out. So, watch out for, whipsaw and for central bank intervention here. They're gonna do whatever it takes to keep markets stable and not, I guess, going into any kind of panic phase over this perceived pandemic that is happening or not happening. We don't really know yet, but the numbers are still pretty low, as I mentioned earlier. Looking at the Dow, we're seeing it did spike up quite a bit on Friday. The weekly chart is still very positive. We're looking at all the PPMs are ready to explode to the upside. I still think we could see something above 100, probably see 102, 103 on the upside. And the Dow is going to continue strong during this period. We're going to see a lot of flight to quality. There's some political stuff going on in Malaysia that's also got a bunch of Asians very, very nervous about what's going on as far as the Asian currency market as well. So there is some things there as well. I don't think they're material, but I'm keeping an eye on those things as they unfold. But I've talked a lot about the Dow. This uptrend is going to continue. There's nothing going to stop it. And when you see the U.S. dollar going up and interest rates going down, you know there's a flight to quality or flight to safety trade going on. The gold market continues to be crazily bullish. Looking at PPM1 at a plus 1.3. We're looking at PPM2 0.43 and PPM3 0.58. We rode right underneath those 10-week moving averages, and it just exploded out of this pattern. Now this objectives that you're going to see up here are, well, it looks like they've been invalidated. They're still very much in play, and those numbers are suggesting a 1750 with the extremes of 1865 to 1931. And so this market is really running away right now. There's a lot of momentum. I'll show you on the monthly graph. It's really starting to come in play on the secular trends. And I've been talking about this for a while. We had a lot of noise on the daily, but now you're seeing secular trends. This thing is just breaking out. The acceleration plus 2.36 on PPM1, PPM2 plus 1.03, and PPM3 0.53. Those are all really big, very robust numbers. These trends, when they get to this level, don't roll over very easily. And so we basically all we saw over the last several months is after we peaked out back in August of last year, we went sideways right into the moving average. Now we're accelerating. All the PPMs here on this secular basis you can just see are accelerating, and they're all making new highs from their previous. So they're setting the tone for a multi-month continuation of much higher prices, and it's not gonna quit and anytime soon. Let's go ahead and we'll cover crude oil and call it a show. The crude oil market really has, we did rally all the way back into about almost $54, and then we pulled back again. We're seeing some further weakness overnight. We're back to around 51.78. But this is likely to hold here. This market's not going to collapse here. I know a lot of people are starting to get really negative on crude. I don't think it's going to go down, and crude oil is telling a story. And you can see these Fibonacci, these dots below the market here. Just mark these. You can see where my cursor is. Those are pretty substantial, $49, $48. We're not going to go below that. And in fact, I talked about this a while back, where the downside objective was for 49.84. We actually got to 49.90 in that period, and we bounced right off of that level. So this is really a broad sideways trading range. This is a short-term daily graph. If we go over and take a look at the intermediate, you'll just see that this pattern is trying to set up a low. You see the PPM 2 and 3 down at the bottom here are starting to break through their first and second derivatives. On a short-term basis, there's still quite a bit of weakness, but the other two PPMs are telling us that this thing's trying to bottom. So I still suspect that we'll see back at 54, somewhere maybe back to $57 within this period. And the secular trends confirm what I'm telling you here, is that you can see this has really just been a broad sideways trading range, and there's really there are some downward Fibonacci projections all the way down to $30. I don't see that happening. There is quite a bit of negative pressure right at the levels where we are now. There's a resistance 52.45 on a secular basis. The next level is 56.41. So I think we continue to hover right in this range where we are right now. Maybe print 49 again, but the ranges, we're going to call it 49 to 56 is going to be the range that crude oil is likely to stay in. So this will complete the show. Thanks as always for watching, and make sure you click the bell and subscribe so you know when I post these videos. Thanks for watching.